Hello and welcome to another episode of Economic Insights. We are back after a break of 1 week. I am joined by Selim, a market veteran of many years and the producer of our show. Welcome.
Hello, Alex. Good to be back.
We are back, and what a week to be back.
Yes, indeed, Alex. Unfortunately, there is only one thing to talk about: tariffs.
Let's just go through what hit the markets. April 2nd, the so-called Liberation Day. Donald Trump announces his tariffs. First of all, there is a flat rate of 10% tax on all imports. And on top of that comes what the administration calls reciprocal tariffs on what they deem to be the worst offenders. Tell us more.
America's biggest trade partners were hit with massive levies. China, an additional 34%, European Union, 20%, Japan, 24%, Korea, 25%, Vietnam, 46%. The list is long. The flat 10% levy has gone into effect already, and the reciprocal tariffs will come into effect on the 9th of April. By most calculations, the effective tariff rate will hit somewhere between 20 to 25%, most likely towards the high-end range.
How did the White House come up with these levels? I mean, some of the numbers look rather ludicrous. Madagascar, 47%. Lesotho, a country Trump himself said no one ever heard of just weeks ago, was hit with 50%. Is there a method to madness?
There is a method, but that doesn't make it any less mad, or even mildly intelligible. The administration wanted to create the impression that the formula was a work of serious economic thinking. But the reality is that it's very simple and deeply flawed. One simply takes the trade deficit for the US in goods with any given country, divide that by the total goods imports from that country, and then divide that number by 2. Simple as that. But services exports by the US to that country do not factor into this formula at all. There is nothing reciprocal about it either.
Doesn't reciprocal mean I do to you what you do to me? Are these countries really charging similar tariffs to the US?
There's no reciprocity in these calculations. They're simply trade imbalances in goods bought and sold. They are designed on the nostalgic fantasies of a geriatric president. They don't fit the realities of the world of trade.
So the additional tariffs come into effect on the 9th? Is there a chance they get rolled back?
This is Trump, so yes, of course he can go back on every word he gave, but tariffs do indeed seem to be his favorite word. It's very hard for them to be rolled back in a meaningful fashion, and hey, they can go up as well. Also, the sound bites from the White House is that they won't be lowered. In any case, negotiations take time, and it's not humanly possible for 100 countries to have meaningful discussions with the administration. How can you talk to heads of states when you're playing an 18-hole round of golf?
The markets didn't take this news very well. Let me just throw some numbers out there. Dow Jones down 8.8%, S&P down 10.5%, Nasdaq 11.5%. A total of $5.4 trillion wiped out from the stock markets.
This is a natural reaction, Alex. The tariffs were much higher than anybody expected. And when you look at the assessment of the economists, the consensus view is that growth will slow, inflation will go up. While the estimates vary, the most optimistic of these call for a slowdown in GDP of over 1%, while the inflation picks up over 1% from its current level. This is a supply shock very similar to COVID. Adding to that, the tax cuts that are being worked on will provide a fiscal stimulus, which is again very similar to COVID. The difference is Fed is not willing to offer the same level of assistance. They learned their lesson that transitory doesn't mean ignore it and it'll be fine.
Yes, that's what Jerome Powell sounded like when he spoke on Friday. They will wait to see how the tariffs play out in the economy. But what about the data? What did last week's data tell us?
Normally, we would be talking about the non-farm payrolls, solid numbers, decent hiring, unemployment, 4.15%, your typical Goldilocks report. But now everyone's saying it's backward looking, and it is. Take the PMIs published over the past week. Composite numbers picking up, services doing very well, manufacturing, even though some level of front-loaded demand due to tariffs anticipation was visible, it was still in growth territory. But none of that matters now. For the next few months, all data will be very muddled, and it'll take time for the full effects of the damage tariffs have done to appear in the numbers.
Let's dive into the market's reaction a little more. Let's start with the interest rates.
The rates market was pricing in 75 basis points of cuts for this year from the Fed before this carnage. Then the pricing went to 100 basis points. Following Powell's cautionary speech, this has been reduced somewhat. I think it's fair to assume the Fed will be cutting rates, but it won't be as fast. June meeting is definitely in play, but May could be too early. 10-year yields dropped 18 basis points in 2 days, but they were down more than 30 basis points at one point. The shape of the yield curve is a hot topic of discussion. Expectations of a steeper curve seems to be the emerging view, but Fed's reaction function is key component here. If they choose to concentrate on inflation, front-end yields stay high, and the steepness may take longer to materialize.
The FX markets had a puzzling reaction to all this. During times of turbulence, US dollar gets stronger as it is considered a safe haven. We saw things play out differently this time around. Why do you think?
There may be a few reasons for that. In my opinion, expectations of growth is the main driver. US was exceptional, and the markets had priced that growth to perfection. Now that's shattered. Also, the yield differential reduced substantially with the rest of the world. Volatility rose sharply in the currency markets. I expect that to remain for some time. What was interesting was gold. A typical safe haven asset ended up lower. The reason for that could be margin calls. Related to selling from leveraged players, hedge funds had their phones ringing on Friday. There could be further counterintuitive market moves over the next week.
Who's most at risk here?
More than the countries and specific economies, I think the credit market is perhaps the one thing to watch out for. The credit spreads were rather tight going into the announcement, but we have seen significant widening of that. This is expected to continue. Is it the next shoe to drop? It may very well be. Commodities space got it especially hard. Copper, which is generally considered an indicator of global demand, dropped 11%. Brent oil was down 12%. But that also had the added impact from OPEC Plus decision to increase supplies starting May. It's a risky strategy at a tricky time.
Countries?
Eurozone definitely. Alongside the US, the bloc is most likely to head into recession. However, the spending plans already put into motion by Germany can mitigate some of the downside risks. ECB was on a rate-cutting path. Now April meeting is also firmly in play. Asia was hit especially hard. Alongside China, Japan, and Korea, saw major tariffs being imposed on them, and this is after they signaled their willingness to purchase more from the US. Emerging Asia perhaps got the worst of it. Taiwan, Vietnam, Bangladesh, India, Pakistan, you name it, they will be there.
Anyone got a get out of jail free card?
Not free, but Latin America generally did get hit less. They seem to be at an advantage. Canada and Mexico were spared, as they were hit with auto tariffs already. UK's tariff was the flat 10%. So there's some relative value play there.
Let's talk a bit about EM and relative value. What looks interesting in your opinion?
Emerging Asia will have its growth reduced significantly. Their currencies may weaken. Some of these countries were already on rate cutting path. I think we will see that accelerate. Next week we have the RBI meeting. They are expected to cut rates. Drop in oil prices will definitely help their cause. Central European economies that are exposed to Europe may be forced to reduce rates. Polish Central Bank, for example, did a spectacular shift in stance, and they even told us they were shifting to a dovish outlook, in case it wasn't obvious. Overall, local currency bonds of emerging markets look like an interesting play. Rate cuts will be on the table for many, and if US dollar keeps weakening, the currency play will also be an added bonus. There are exceptions, of course.
I guess you mean South Africa?
Yes, that's definitely one. If it was a competition of who shot themselves in the foot this week, South Africa would be the runner-up, admittedly by a distance. GNU seems to be breaking up. We will know more Monday, but at a time when the relations with US are fraught and tariffs are being slapped on them, this is not a great time for damaging politics.
When you say damaging politics, Turkey comes to mind.
Yes, But strangely enough, Turkey almost looks like a safe haven. Admittedly, the central bank did a wonderful job of calming the market anxiety by buying bonds this week and selling dollars since the start of the crisis. It did cost them $30 billion, though. The reality is, Turkey seems to be in a relatively good place internationally. The tariffs were relatively low at 10%. Europe needs them for security. China is looking to invest there. The recent inflation figures also were rather benign, but I would wager the rates will remain unchanged at the next meeting. Egypt is another country that may benefit. Yields are high, but rate cuts are imminent and can be sizable. Tariffs are also at the baseline rate of 10%.
What should we look out for in next week's calendar?
I'm not sure how much data matters at this point. We have the inflation from the US, but that means little anymore. If there is an uptick in the headline or the core number, that would be worse, of course. It would mean additional inflationary pressure on top of an already sticky situation. Perhaps the only thing we will all be watching out for will be headlines regarding the trade wars. Retaliations, negotiations, all will be moving markets in different directions.
All right. This was a great conversation. Any last words?
I would like to petition for April Fool's Day to be moved to April 2nd.
You said it. Great to have you here, Selim.
Good to talk to you, Alex.
Okay, folks, we came to the end of another show. Don't forget to like and subscribe. And don't forget, we are not giving investment advice. For that, consult a professional. Until next time, good luck.